All right, guys, let's start. Okay. So today we are doing the first topic of your current issues, right? Sorry, corporate issues, right? Current issue is a topic in FRM part 2, right? So we are doing the first topic of your corporate issue, right? Very easy topic. See, corporate issue is all about theory, right? It's all about your theoretical understanding of your organizational forms, your corporate issue features, and your ownership, right? We'll look at the features of corporate issuers, the introduction part. There's only one module here, so not very difficult. Very easy, very story-like kind of chapter, right? Just try to understand it and then we'll go forward. Okay. All right. Let's start. As we advance in this chapter, right, the first and foremost thing you need to keep in mind, right? Every one of you, right? Please understand that as we talk about the organizational forms, your corporate issue, features, and ownership, the organizational form means that it describes how a business is legally set up and how it operates, right? That's the organizational form. Key things we have to look at when you look at the organizational form is whether something is separate legal entity or not, whether it is who is running the business, etc. Right? That we'll try to understand, right? Then we look at the corporate issue features, whatever the type of organization, but the features of that, and what about the ownership, right? So that's what we'll look at, and that's the first module, right? So let's now dig deeper. Okay. Perfect. So this topic is further subdivided into your 5 topics. Organizational form of business, key features of corporate issuers, double taxation of dividends. There is an example, public limited companies and your private limited companies. Okay. So let's start more. All right. So this is your first part, which is your organizational forms of your business, right? See, when I talk about your organizational forms of business, what you need to understand very clearly is that organizational form describes how your business are set up from a legal and your organizational point of view, right? So you have to keep in mind your legal framework as well, right? Legal and your organizational form, right? Now, key things which you have to look at is you have to ask if the business is legally separate from the owner or not, right? Then you have to find out if yes, owners are kind of protected or not, if no, owners are personally responsible or not, who is running the business. Owners may run it themselves when it is a small business, or owners appoint your managers when it's a corporation. What is the owner's liability? Unlimited liability. Owners pay business debt from your personal assets. Limited liability, losses limited to the investment amount. Tax treatment is what? Profits may be taxed only once those are passed through or twice. Corporate level also and shareholder level also. Access to capital, right? How easily the business can raise money to grow, right? Once we have figured out that, then we have to understand the 4 common business structure, right? 4 common business structure are sole proprietorships, general partnerships, limited partnerships, and corporation. Now, what it is, right? What is a sole proprietorship? See, sole proprietorship is your owned and run by your one individual, not a separate legal entity. It's a basically your owner-centric organization, right? Liability, unlimited liability. If business fails, owner's personal assets are at risk. Taxation, profits are taxed as your personal income of the owner. If you look at the scale, usually small scale, capital depends only on the owner's personal ability to grow and invest. And it's a very simple structure, easy to start, but high risk for owner, right? Very, very high risk for owner, right? So that's what we are reading here, right? Then as we go ahead, next is general partnership. General partnerships, 2 or more people run a business together, not a separate legal entity. Partnership agreement defines your roles and responsibility, profit and loss sharing, liabilities, unlimited liability for all partners. Each partner is responsible for business debt. Taxation, the profits are passed through and taxed as personal income of partners. Access of capital is still limited, depends on partners' resources. And what we need to understand here is that general partnership, mostly it is your shared ownership, shared risk, but no liability protection. Okay, keep that in mind. Then we go into the next part. Next part is about your limited partnership. When you talk about limited partnership, what you need to understand is that limited partnership is very different from the previous 2. In limited partnership, there are two types of partners. One is the general partners, GPs. Then there is a limited partners, LPs. It's not a separate legal entity. Management managed by your GPs only. General partners, limited partners do not participate in your management, right? And liability, when you look at general partners have unlimited liability, limited partners have limited to your amount invested, right? That's what we have. If you look at your taxation, profits are your pass through, taxed as your personal income of your partners. You look at your access to capital, still limited, but better than your general partnership because LPs invest their capital. Risk and control sits with your general partner, GPs. LPs provide your money with your limited risk. Okay. This is your limited partnership. Okay. Then we go to your corporations. Okay. We talk about corporation. Please understand corporation, what it is. It's a separate legal entity from your owners and managers, formed by your filing of your articles of incorporation. You look at your rights and responsibility, can hire employees, can enter your contracts, can borrow and lend money. If you look at the management, shareholders elect your board of directors, board appoints your senior management, your clear separation of your ownership and management. If you look at the owner's liability, the shareholder have limited liability. Maximum loss is your investment value. Share can go to zero, right? If you look at your taxation, it's a double taxation possible. Company tax on your profits, shareholders tax on your dividends. So double taxation is possible here. Access to capital is the greatest access because you can have equity, you can have your debt, and consider virtually unlimited access to capital, right? Overall, from the example structure, understand that it's the best structure for your large business despite your double taxation. So that's what we need to understand. Okay. So this is a key feature here. Then once we understood this, then we go to the key features of a corporate issuer. See, when we talk about the key features of a corporate issuer, what we need to keep in mind is that, first of all, we need a separate legal entity. Separate legal entity means corporations exist independently of owner. Then we need to look at your legal rights, can hire, contract, borrow, and lend. Then look at your issuance of shares. Raise large capital by selling your shares to shareholders, voting rights. Shareholders vote to elect the board, transferability of shares. If listed shares are easily transferable. Dividends, boards may distribute earning a dividend. Then we look at double taxation impact, less severe for companies that retain earning instead of paying your dividends. Overall, the point here is that corporation trade flexibility, corporation trade capital access for higher regulation and taxes, and that's what we need to understand, right? So there are definitely some disadvantages that you need to keep in mind. Okay, the disadvantage of double taxation of company is less for investors in companies that pay out a small fraction of their profits in dividends and reinvest the earning. The board of directors may distribute a portion of the company earning to the shareholder as dividends, easily transferable, voting rights, etc. Okay, keep that in mind. Again, these are features, guys. Features you have to understand. Now we have an example, double taxation of dividend example. We have a ABC Corporation has tax earnings of $10 million and a corporate tax rate of 25%, dividend tax at 20% on the dividend income. You have to calculate the effective tax rate. There are two cases here. One is 100% of profits are paid out in dividends. And second is the 40% of profits are paid out of dividends. Now, the screenshot is given there, right? If the 100% payout is given, you look at it, right? See, the pre-tax earnings are given to you 10 million. Corporate tax is 25%. The dividend tax is 20%, right? So in the first case, A case, you look at it, corporate tax is your 2.5 million. Why? Because 10 million, you put 25% becomes your 2.5 million. Okay. So after tax income becomes 7.5 million, right? 10 minus 2.5, right? Dividend tax on top of that, right, will be 20% because you're paying 20%, right? On your dividend tax, which is given in the question, right? So if you have to put 20%, you have to put on your dividends, right? So after tax income, you are putting 20% on that. That is dividend tax. So that goes out. So now your total tax paid is what? Total tax becomes a 4.5, basically 4. 2.5 plus your 1.54, right? So total tax you are getting is effective earning you are getting as 40, right? That's what comes to your mind immediately, that the total tax here is 40%. Okay. Then same thing. You are going at 40% payout, right? Uh, in that case, your corporate income tax is 2.5 million. That's fine, right? But when you go to your dividend is 3 million, right? Right, and the dividend tax is your what? Dividend tax is 0.6, right? So effective tax rate comes out as 31%, right? So what are we getting here, right? What we are seeing here is if 100% of profit are paid in dividends and 40% of profit are paid in dividend, there's a difference which is coming, right? The lower dividend payout leads to your lower effective tax rate, right? So that's what we can keep in mind, that you don't need to pay out whole of your after tax income as dividend, right? So that's the whole idea, right? All right. Then we go to your public limited companies. What are they? Basically, public limited companies are those companies where shares are sold to the public, right? They trade on a stock exchange. There is a trading and valuation. Prices are determined in a transparent, rule-based market. There is a free float. Free float means the shares which are available for your public trading. There's a regulatory requirement. Must file your quarterly, annual reports, whatever the requirement. Disclose material information. If you're going private, you have to the acquirer have to buy all shares and delist the company. Benefit is low regulatory burden, cost savings. Overall, what you need to understand is that public companies gain liquidity and capital, but face your heavy regulation, right? So the essence here is whatever we have studied till now is that if you have unlimited liability, right, in your structure, you should kind of avoid that structure. If you have limited liability, that is preferred. Corporations can scale and get capital easily. Dividends have higher taxes, and retained earnings is a tax efficient way, which is by giving limited dividend, right? So that's what we are talking about here. Okay. Then we go ahead, guys. Then we have the private limited companies. When I talk about the private limited companies, what's a private limited company? Please keep in mind that private limited company is similar to a public limited company, but it is it has limited number of shareholders. OpenAI, Anthropic, right now, all are private limited companies, right? The restrictions on share transfer, shares are not listed on the stock exchange. When you talk about the trading and valuations, share do not trade on an exchange, hence market price is not observable daily. Valuation is kind of difficult. Exit is hard. Investor usually exit when company goes public, company is sold. So today there was a company in India called Grow, right? Billion Brains. This is company related to mutual fund, stock broking, right? So that company investor exited today when there was a lock-in period exit finished, right? So private company shares is equal to your illiquid plus hard to value. There are certain regulatory requirement, but generally there are fewer regulatory requirements than your public company. Less disclosure, no quarterly earning pressure, can take a long-term business view. Less regulation, more flexibility. Raising capital is via your private placements, typically restricted to your institutional investors, your corporations, high net worth individual, accredited investors. So no public issue. It's a limited investor base, right? Then once they go public, right, a private company can go public in many ways. One is your take out an IPO, one is your direct listing, one is your SPAC acquisition, right? So that we'll talk about ahead, right? Acquired by a special purpose entity, that's called SPAC acquisition, right? So that's what we'll discuss ahead. Okay, fine. Now these are the ways by which the company can go from your private to public. I told you there's a IPO. IPO is what? Company issues your new shares to raise capital. Company must meet your exchange requirement. Company must engage an investment bank as your underwriter. After that, shares trade freely. Company not involved in your daily trading. Overall, there's a new capital which comes from the investors, but there is an underwriting which is done by investment bank. There is a regulation which has to be followed. The other method is direct listing, exchange list existing shares only. That's the difference, right? You only list the existing shares, no new capital raise in the direct listing. Advantages are faster, cheaper. There's no underwriter requirement. So direct listing gives you liquidity, but it doesn't provide you any kind of fundraising. IPO provides you fundraising, right? Then we have SPAC. SPAC is special purpose acquisition company. It's a blank check company. Raise money via your IPO, puts money in your trust. Must acquire a private company within a fixed time. Target company not known at the IPO. So overall, you must understand that it is a faster route to a public market, but there are a lot of complication here. That it's a blank check company that is raising their capital through an IPO, placing funds in trust, and there's a time frame, right? Must acquire a private company within a specific time frame, right? All right. So this is what it is. Very simple and very straightforward, right? I hope everybody followed, right? Then we have the practice question. Let's do it. Uh, D's Arbor Group, DAG Inc., is a large multinational investor in your timber and forest located at the North and South American continents. DAG Inc. is the general partner of DAG LP, a limited proprietor that is a 100% owner of timber and forest asset. DAG LP is controlled by DAG Inc. All right. And its limited partners, DAG LP is controlled by DAG Inc. and its limited partners. Limited partners own a 20% stake in the partnership, while the DAG Inc. holds the remaining majority stake. DAG Inc.'s shares are listed on stock exchange in the US and Canada. DAG Inc. is organized as a special corporate form available in its jurisdiction in which it does not pay corporate income tax so long as it distributes all of its net income as dividend to its shareholder and complies with other conditions in the current and past fiscal years. DAG Inc. has complied with all these conditions. DAG Inc. shares are owned by various members of D family who hold several key senior management positions at DAG Inc. and DAG LP, and collectively they own 30% of shares of DAG Inc. The remainder of DAG Inc. are owned by a variety of individual and institutional investors. None of them own more than 5%. The following diagram shows the organized structure of DAG Inc. and LP, right? So let's see the structure. Long, lengthy question. So this is the structure which we are getting. The timber and forest asset that come into your DAG LP, then it is subdivided into DAG Inc. and limited partners. DAG Inc. has D family members and outside shareholders. Now the question which is there is what percentage of timber and forest asset are effectively owned by the D family members in this scenario, right? See, I'll try to answer it. See, this long question, you have to cut the fluff, right? You have to come to directly to analysis, right? So D family, right? Right. When you talk about D family owns your 30% of your DAG, right? And DAG Inc. owns 80% of DAG LP, right? So basically, your DAG LP, right, owns the asset, right? This is given in your diagram also. Now, if you have to take the question asking what percentage of timber and forest asset are effectively owned by D family, right? So we are talking about D family members, which is this, right? So effective ownership is what, right? Simple point is that you directly go that I have written here DAG Inc. own 80% of DAG LP. DAG LP owns the asset. So, and D family owns 30, right? So the relation between this and this, right? DAG Inc. and D family members is 30%. Relation between DAG Inc. and DAG LP is 80%, right? So, and idea is just multiply it, right? 80.80 into 0.30, right? This 0.24, 24%. Very straightforward, very easy. Yes, you have to take out the information which is given in the question, okay? All right, then we have more questions. Which of the following best describes the taxation, right? Which of the following best describes the taxation of DAG Inc. and your LP? See, when we read the question, it was clear that DAG Inc. is a special corporate form, pays no corporate tax, right? If you go back to the question, right? DAG Inc., right, is a special corporate form, right, which does not pay any income tax, right? the special corporate form available does not pay any corporate income tax, right? So this is given in the question, right? So that is a relief that, okay, fine, we know this much, right? Now, income is distributed as dividends, right? So let me write it down if it has to be made, right? DAG Inc. Special, all given the question, guys. Corporate form, right? Pays no corporate tax. Income distributed as your dividends. Okay. Then you have DAGLP. Okay. And it's a pass-through entry. Okay. So the correct logic here is that shareholders of your DAG Inc., right, pay tax on your dividends, right? And partners of DAG LP pay tax at your personal level, right? So that's the whole idea, because income is distributed as dividend. So DAG Inc. shareholders pay tax on your dividend, and your, since DAG LP is a limited partnership and your pass through, right? So here partners of DAG LP pay tax at personal level, right? So that's what it is. So this is correct. This is okay. DAGLP pay tax on pre-tax income? No, DAGLP pays on your what? DAGLP pays tax at your personal level, right? So this is wrong. DAG Inc. Pays tax based on pre-tax income. This is also wrong, right? So they pay on dividend income. Okay. Then you talk about the description of your DAG LP and your DAG Inc., right? So again, if you go back and see the question, right, it is given that DAG Inc. is a general partner of your DAG LP. General partner has unlimited liability. DAG Inc. shareholders has limited liability. So that's what we are getting. So neither DAG LP or DAG Inc. is managed by a majority owner. Wrong. DAG Inc. has limits to its ability to raise new capital because of dividend requirements, corporate form. Wrong. DAG Inc. faces unlimited liability as the general partner. Yes, general partner has unlimited liability, that you have to remember, right? And DAG Inc. shareholder, you know, as a corporation implies, the shareholder face limited liability. Yes, that's also true. The shareholder face limited liability, right? So this is C. Okay. Be careful. Easy questions, but tricky, right? Next one is your question number 4. Here, what is the significant difference between the limited partners of DAGLP and the outside shareholders of DAG Inc., right? So the significant difference between the limited partner of DGLP and DAG Inc. is that limited partner of DGLP no voting rights in the DAG Inc. and cannot replace the board, right? Outside shareholders of DAG Inc. have voting rights and your can influence your board decision, right? So ability to vote and replace members of DAG, right? What is the significant difference between the limited partners of DAG LP and the outside shareholder DAG Inc., right? That outside partners have voting rights, outside partners can influence your board decisions, right? Which your DAG LP cannot do because there is no voting rights of DAG Inc., no voting rights of DAG LP in DAG Inc., and you cannot replace your board, right? So remember that as well. Very tricky. The next question here is, which of the following rationales would be most consistent with the D family choice to create this complex organized structure instead of simply organization or organizing as a limited partnership? Basically, the idea is the D family wants to control the management, right? And they have only your 24% effective ownership, right? And they want to control the management with only 24% effective ownership while maintaining your limited liability. If they have gone for a simple limited partnership, that would require higher ownership, which they don't want to take. That would have required unlimited personal liability. That is also a no-go, right? So you want to have management control without the need for majority ownership by the family while also maintaining limited liability, right? So that is why this complex structure you have. Overall, what you need to understand is that if it's a private company, it's illiquid, less regulation. If it's a IPO, it's a capital plus compliance. The direct listing, it's a liquidity only. SPAC is fast public access. And when you go to such kind of question, your LP plus your corporation combo, it's all about LP is all about your control, limited partnership, and corporation is about your limited liability, right? So that's what you need to understand. Okay. So keep that in mind, guys. I think that's yeah, these are the answers. This is what we found 24%. That's perfectly fine. So that was great. Then it was B, which I told you that DLP is a limited partnership, income passed to each partner and partner paid the personal level that I explained. Uh, Again, this is C. DG is general partner, does the unlimited liability in the partnership. However, the corporation DG shareholders have limited liability for its losses and obligation. DAG-LP is 80% owned by DAG Inc. General partner that manages the partnership, right? And DAG Inc. is 30% owned by the D family, which holds several key management positions. So B is correct here. And then you go to the next question, which is two questions which are there. Then we have question number 4, where I told you that limited partners of DGLP are not shareholders of DG Inc. They don't have voting rights in the corporation. And question number 5, the D family can effectively control management of the timber and forest asset with only 24% ownership, right? So that should not be a problem, right? And how they can do is that they can always, the D family can effectively control management timber and forest asset only 24% because they can control the management, right? So if the family has opted for limited partnership as the organized form, they would likely need a much higher ownership stake to assert a management control and would have unlimited personal liability. B is incorrect. The double taxation problem is not an issue in the more complex pass-through. C is incorrect. Right, right, C is incorrect because the complex structure potentially creates problem because of existence of outside shareholders, right? So that's what we have, right? So yeah, fifth was A. It provides management control without the need for majority ownership of the family while maintaining liquidity, right? So that's it, guys. Just 5 questions, right? This chapter is very small, but if you're doing for the first time this chapter, you will be confused. Keep that in mind. Study slowly. Try to understand the difference between your all these features, right? Which is your proprietorship, your limited partnership, your public, private, right? What are the different things? Your trading and valuation, your regulatory requirement, you're raising capital, you're going public, right? All those things you need to keep in mind, right? Once you understand that, I think then it's easy, right? Key features also different types of forms of business, right? Taxation and partner liability, etc. Right? Please understand. You should be very clear that what is the liability of your sole proprietorship, what is the liability of general partnership, what's the liability of limited partnership, what's the liability of a corporation, right? And what the benefits of one structure than the other, right? So you should be aware of that. Okay, that's it, guys. That's what completes our chapter. So I'll see you in the next lecture. Okay, thank you.